Welcome back. Today we're jumping right into an analysis arguing that Herbalife's turnaround is finally here. It's projecting a $15 price target, pinning the whole thing on a turnaround in North American sales and a massive short interest setup. Let's start with the foundation of this bull case because I think that's where we can really strengthen this argument. The entire thesis really seems to be built around one single number, that Q3 North American sales growth of plus 1% year over year. And I get it, it's the first positive quarter since Q2 2021. So the piece is essentially saying the bear market is over.
And it's a powerful number, you can't ignore it. But here's the first challenge I see. We have a result, a really compelling result, but we don't have the process that got us there. That 1% figure is being treated as the fundamental answer, but I think it's just a symptom.
So where's the weak point? What's the hole a bear is going to try and shoot through here?
The weakness is that if you only rely on that one number, you're leaving the whole thesis open to the counterargument that Q3 was just, a fluke. Maybe it was a one-off, some seasonal strength, inventory restocking, anything but a real sustainable change inside the company. So the analysis proves that the sales decline is over, but it doesn't prove how management actually fixed the problem. And if you want this to be seen as a true re-rating, not just a momentum trade, you have to show those operational drivers.
Yeah, I see the risk. A serious investor is going to ask, okay, what specifically changed on the ground? And if the only answer is sales went up 1%, well, they're probably going to walk away.
Absolutely. So my suggestion here is pretty straightforward. You have to bring in some specific non-financial data. You need to clarify what strategically drove this pivot in North America to prove that it can last more than just one quarter. We need to see inside the engine room, so to speak. This goes beyond just the financials. For an MLM, it's all about operational stability.
So we need to show why this 1% isn't just a blip, but the first step in a much longer climb.
Precisely. And we can do that with some concrete examples. Let's move beyond the P&L. First, I would dig into the Q3 earnings call transcripts. Look for any details on distributor health. Did management say anything about distributor retention rates? Because in this business model, retention is a far better indicator of long-term health than just net sales. Net sales can be juiced with a big promotion. Retention, that shows you have a sticky product and a loyal base.
That's a great point. If retention is up, that 1% growth is solid. If it's flat or down, the number looks a lot shakier.
Exactly. And second, I'd look for commentary on changes to how distributors are paid or recent marketing shifts. Which specific product lines drove that growth? Was it just one new energy drink? That's a narrow thesis. Or was it their core nutritional products? That's a much broader, more stable foundation. You have to link that positive 1% directly back to a decision management made. Maybe they launched a new digital platform or a new onboarding process. Then you can use that data to build a much clearer path for future growth, and you've completely shut down that one-off quarter argument.
Okay, let's pivot to risk. The analysis is very bullish. The turnaround is here. But any piece on Herbalife has to deal with the systemic risks of the whole MLM structure. The report does flag regulatory watch as a risk factor, but it's sort of listed right next to things like currency headwinds.
And this is where we have to talk about the significance of that risk. The report does a really good job on the financial health side. The debt reduction, getting that leverage ratio down to 2.8x, that's a huge positive. It takes bankruptcy risk off the table. But the really bullish conclusion doesn't quite square up against the high-impact, low-probability risk of regulatory action. That's not the same as a short squeeze.
So is there a danger that by just listing regulatory watch as another volatility factor, the analysis is downplaying something that could actually kill the entire thesis? A regulatory crackdown isn't a dip. It's a fundamental change to the business.
That's the critical distinction. Regulatory risk isn't just volatility. For this sector, it can be an existential threat. My suggestion is to give that headline risk more strategic weight. International revenue is still a huge piece of the business. So you need to assess the political and legal stability in their key international markets. You have to actively argue why a shock event is less likely now than it was in the past.
But wait a second. If we're telling the analyst to give this risk more weight, doesn't that make the $15 price target harder to defend? We're emphasizing the downside.
Not if you use the company's strengths to directly fight that risk. This is the key strategic move. You contrast the severity of that regulatory watch with the company's now improved balance sheet. They just paid off $147 million in notes. That's a massive deal.
Ah, so you turn the defense, the debt payoff, into an offense against the fear of regulation. That's smart.
Precisely. You demonstrate how that lower leverage ratio of 2.8x acts as a specific financial buffer. a buffer against potential fines, against legal defense costs, whatever might come. If you can show that the balance sheet is now strong enough to absorb a worst-case fine without crushing the company, then that debt reduction isn't just a good financial metric. It becomes a strategic regulatory defense. You could even cite a quick example of a competitor that failed because it didn't have that buffer when a regulator came knocking.
We've definitely seen that before. A sudden, massive fine from the FTC can just wipe out a company if its debt is too high. So by showing that the 2.8x leverage ratio gives them a safety net, you make the argument for survival much, much stronger. It shows you've thought about the number one bear case and built a shield against it.
And you can tie the short interest into this too. That float is at 15.2%. You should ask, is any part of that short interest specifically betting on a regulatory event?
You could suggest looking at the options market. Implied volatility spikes around international regulatory news. That would require a much deeper counter-analysis on the legal front, but it shows the short pressure isn't just technical. It might be sophisticated regulatory betting that the company is now, finally, in a financial position to withstand. Which brings us perfectly to the technical strategy, which leans so heavily on that short squeeze. The analysis does a good job laying out the factors. Strong bullish trend, it's testing that key $12 level, you've got the 15.2% short interest, a massive 10 days to cover, and, crucially, an overbought RSI above 70.
Okay, so this is the setup that every momentum trader dreams about, a short squeeze. But a setup this aggressive, with this much volatility baked in, it needs a scalpel, not a sledgehammer. The report correctly flags the tension here. The RSI is overbought, and it says to expect some choppy volatility or a brief dip.
Which is good advice. It's telling the reader not to chase the rally.
Yes, but here's the weakness. Predicting that choppy volatility is a great warning. But the analysis doesn't really integrate that expectation into a focused, timed trading strategy. The path from the technicals to the $15 target is just too straight, too linear for a stock where 5% moves are, a daily thing. It doesn't use that predicted volatility to its advantage for timing an entry.
So to make it really actionable, we need to use those indicators to define the high probability entry points. How do we leverage that expected dip? Or alternatively, confirm that the breakout is real?
My suggestion is to use those specific indicators, the overbought RSI, the short interest, the support levels, to lay out a timed multi-step strategy. It's not just about where the stock is going, but when to get in.
Can you give us a few concrete examples? How do we make this practical for a reader looking at the stock right now?
Okay, first, instead of just saying that $9.50 to $10 is a support zone, suggest a strategy where a pullback to that $10 level offers a much better risk-reward entry. You're essentially advising the reader to avoid the classic mistake of buying right into an overbought RSI peak. Wait for the RSI to cool off from that 70-plus level, and you can even quantify it. Show the risk-reward at $12 versus the risk-reward at $10 to really drive home the value of being patient.
Okay, that covers a patient entry. But what about the aggressive one? The one that plays the actual squeeze?
We have 10 days to cover. That's a huge metric. It means shorts will have to scramble if the price moves against them.
Right. So we use that metric to define a high-volume confirmation point for the real breakout. A close above 1250 is the trigger, but not just any close. We need a signal that the shorts are truly starting to panic. And what kind of signal would that be? If I'm reading this, how do I calculate what normal volume is for a stock this volatile?
That's a great question. For a stock like this, I'd suggest using the 20-day simple moving average of volume. It smooths out the daily noise, but still captures recent momentum. And based on that average, you could suggest that you need to see daily trading volume exceed, say, 1.5 times that average on a close above 1250. That's the kind of volume that forces shorts to buy back in. It separates a real confirmed squeeze from just speculative testing of a resistance level. Suddenly, the technical analysis becomes a dynamic roadmap for how to trade it.
And finally, with the short interest and implied volatility so high, you almost have to mention the options market.
Absolutely. You should discuss how that short interest is pumping up implied volatility. Instead of just buying shares, maybe suggest a risk-defined strategy, like a call spread. That would frame the high-risk, high-reward nature of the trade much more clearly for a sophisticated reader who wants to play the volatility without taking on unlimited risk. It just adds a layer of professional polish that really matches the conviction of the thesis.
This has been a really productive session. I think overall, the analysis makes a very compelling case for the Herbalife turnaround, and we've identified 3 clear pillars to make that argument even stronger, almost bulletproof.
First, you have to deepen the explanation of that North American pivot. Focus on the operational why behind that Q3 growth. Track things like distributor retention or which product lines are working to prove this is sustainable.
Second, you need to weigh that MLM regulatory risk strategically. Don't just list it. Use that improved 2.8x leverage ratio to show exactly how the company is now financially buffered against fines, effectively turning debt reduction into a regulatory shield.
And third, take those great technical observations, the overbought RSI and the 10 days to cover, and build a more nuanced entry strategy around them. Define a specific volume trigger, like 1.5 times average volume on a break of 1250, to confirm the squeeze. Focus on timing the entry, not just naming the target.